Hi there, my name is Andrew Macken. Welcome to this week's edition of Video Insight. Now, many investors and industry pundits talk about a stock's dividend yield as a critical factor to consider when making an investment decision. It surely is an important aspect to consider from a capital allocation perspective, i.e. what the company's managers are doing with the excess cash on their balance sheet. However, all too often, this is not how many talk about dividend yields. Instead, many make the comparison between dividend yields on stocks and yields on less risky investments such as bonds or term deposits. A typical argument might go as follows. A one-year term deposit will currently give you, say, 2.7%, whereas the dividend yield on, say, CBA is 4.6%. Therefore, CBA is a much better investment. Now, the fundamental problem with such a comparison is the implicit assumption in the analysis that in both cases the initial principal will be returned to you, the investor. Of course, this is only true for the term deposit, not for the equity. Your ultimate return from an equity includes both the return from dividends as well as the return from the change in the stock price, known as the capital gain or loss. In the case of CBA, for example, the stock need only fall to around $86 from its current level of $91 to wipe out a year's worth of dividend. And where the stock price ultimately ends up is a reflection of the company's fundamental prospects from that day onwards. Take BHP as another example. And by the way, buying a mining stock for its dividend yield is absolute madness in my view, though I note that it is being pushed by a number of brokers on the street. Just 2 weeks ago, BHP had a dividend yield of about 4.7%, which sounds pretty attractive relative to term deposits. However, since then, the stock has fallen 13%. That means 2.5 years' worth of dividends has been wiped out in just 2 weeks. Finally, I know many Australian investors who are in low tax environments love the franking credits that typically accompany dividends from Australian companies. And yes, I understand that for this group of investors, the franking credits increase the effective dividend yields of these stocks by, say, a couple of % or so. And this is certainly a nice benefit. However, the stock price need only fall by that same 2% over the course of a year to completely wipe out this benefit. As the saying goes, you want to make sure that you are not picking up nickels in front of a steamroller. We'll leave it there for today, and as always, don't forget to follow us on Facebook and Twitter.